Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd, 2024. Stay tuned for tickets. Today's guest is a veteran precious metals analyst and the founder of the TF Metals Report, somebody I always enjoy speaking with. It's Mr. Craig Hemke. Great to see you again.
Jesse, it's great to see you. I'm laughing because I'm a veteran precious metals analyst. I remember when I started doing this about 15 years ago, that was Jim Sinclair and Mr. Turk and, others that thankfully are all still around. But I guess now I've kind of become like a veteran of Maven myself, just with the passing of time.
Yes, absolutely. Well, you're very well respected in the industry, so just wanted to point that out. And I want to get started with sentiment I'm seeing this in the precious metal space. I'm seeing this in the uranium space, which I watch pretty closely, and kind of across a lot of the commodities in general. Sentiment seems to be at an all-time low. People are throwing in the towel. I'm seeing some dramatic posts of people saying they're out, they're finished with the gold and silver sector. They've been, holding for 15 years and it hasn't gone according to their expectations. So what do you say to people when it comes to that low level of sentiment? I suspect a lot of these people are investing money they can't afford to lose in speculative mining stocks, et cetera. I think this is more when it comes to the mining space. And, what do you think is the cause of this low sentiment in the sector? Are you seeing it as well? And what would you say to those people?
I think you nailed it, Jesse. It is the people that are investing in the mining shares, of which I'm one. Okay, I'm not trying to ridicule those people. I mean, I just updated all one of the things I do on my website for the subscribers. I list all of my holdings in my IRA and in my personal accounts, just to show them what I own. And I'm getting the snot kicked out of me. I updated them last night for the first time since the end of March. And I was like, oh my goodness gracious. And I think that's it. Because my physical metal couldn't be more valuable at this point. And you look at gold, my friend, and I consider him a friend, Ronnie Sturfula of Incrementum puts out the In Gold Trust report every year with his team. And buried in that report is a little table of gold prices in every major currency since the year 2000 and the annualized returns. And the there's redundancy for you. The annualized annual return in gold, about 9.5% for the last 23 years. Okay, let's see. So far this year, as we speak, front month August gold is back above $2,000. The front month February gold finished on New Year's Eve or the day before at 1829. So it's up 10% year to date. And yet everybody's, suicidal. And why? It's because these mining shares are just ruthless. And I initially swore them off in 2013 and said, I'm never dealing with these things again. All they do is lose money, and then they come back and beg for more money, and which is mostly true. However, there are periods when the herd rushes in. I think of kind of similar to now, the end of 2015 into 2016, the Fed was talking a good rhetorical game about quantitative tightening and what they call it. They were Operation Twist. Remember that term? And all of a sudden the economy began to slow and they had to pause everything that they were doing. And the Hui index bottomed, I think, at 99.19 on January the 19th of 2016. And by August, it was like 280 or 260. They're like almost tripled in 8 months. And that's why, people continue to hold it. But I certainly understand why people run up the white flag. There will probably, because there were true believers in the first place, when gold breaks out later this year, they'll come rushing back in, and that'll be all part of the next wave higher. But I think you're right. The sentiment, the depression people feel is just because, you see these NVIDIA, these other stocks that are, going up 50% in a couple of days, and their mining shares, it just seem like they never go up at all.
Yeah, and I wanted to touch on NVIDIA and the tech sector with you as well, because it seems like they just keep ripping higher this kind of small group of blue chip tech stocks that are holding up, the S&P. People keep talking about a dramatic crash coming, but and this can't go on forever, obviously. But what's your view here? Why do you think we're continuing to see this? Is this signs of a blow off top? Is there going to be a large correction, a market crash incoming, in your view?
Well, I think there's two things at play. Your channel has a lot of smart people on it, so I don't want to make it sound like they don't know this, but the S&P is a weighted index. And if it was equally weighted, S&P 500, and all 500 stocks made up 0.2% of the index, the index would be down about its March lows. Okay, it'd be, I mean, down 3,600, something like that. But it's not. There are a handful of stocks that are vastly overweighted. That NVIDIA is what, I can't remember what it is, 7% now. So that index is driven by just legitimately a handful of stocks, 5 or 10. So as long as the flows of cash are going to those 5 or 10, it creates this, it's almost like a mirage of market strength. So that's the first part of that. The second is, and Ronnie wrote about this too in that report I just mentioned in Gold Retrust. I've been talking for a couple of months about, maybe the end result of this is finally that crack up boom that so many have, opined would be an end result of all this for about the last decade. In that, in the end, the central banks are going to be flushing so much cash into the system that all that cash has to flow somewhere. And basically everything goes up. Bonds go up as rates go down. All these equities go up. Bitcoin goes up. Even the mining shares go up. And that we may be sensing a part of that too, because the market is almost operating more on the biggest fear driving it remains a fear of missing out. The greed component far out exceeds the fear. And so those waiting for a crash, there's this arcane notion from when I first got into the securities business 30, 32, 33 years ago that fundamentals matter. No, they don't. Flows of funds matter. And as long as there's liquidity and increasing liquidity, it's going to find a home. And that when in a weighted index like the S&P, it can just keep going up.
Well, you spend a ton of time looking into the gold and silver sectors. You're always giving updates on the TF Metals report. So I know we always talk about this every time and it seems redundant, but I want to know what your broad macro overview is for those metals. And we'll start with gold. So, what are both the main tailwinds and potential headwinds you're seeing for gold as we sit here today?
Well, Jesse, you'll remember from other times that we've spoken this year. I write like an annual forecast. I call it a macro cast, because if you're going to track gold, I mean, there are those people that are like technical analysts. It's just a dot on a screen. Okay. But for those of us that, recognize the fundamental value of sound money, it's more than that. And if you're going to track it, and whether you want to buy it or hold off and buy later, that kind of stuff, you got to keep track of all sorts of things. You got macroeconomics, geopolitics, monetary policy, what's going on in Europe, because that affects the euro, which affects the dollar, which is a big part of the dollar index, and the HFTs follow the dollar. I got all this stuff you got to keep track of. So I write what I call a macro cast every January, if anything, to hold myself accountable so that I can go back at the end of the year and see, I might kind of remember what I was talking about, but I'm getting older. I can forget what was my dominant idea as the year began. So I like to have it as my own little thing. I can go back and look and see what I got right and see what I got wrong. And this year, the whole idea behind the macrocast, it still holds sway, is that the year 2023 is most analogous to the year 2010 and the year 2019, which, again, accepting the premise that everything changed in 2008 when suddenly the Fed started directly monetizing debt and QE and all the other central banks. We went from $1 trillion in balance sheet on the Fed to $9 trillion, everything changed in 2008. Okay, so in 2010, people have been, might recall the term bandied about called green shoots. They're the green shoots of the economy. They're coming up from the rubble of the great financial crisis. And the Fed was a one-off. They were never going to QE again, and rates are going to normalize and all this kind of stuff. Then the economy began to falter. We had 2 negative quarters of GDP in the middle of 2010. And lo and behold, what happened? November 2010, here came QE number 2, which we were told just even months before was never going to happen again. What the metals do? They went sideways for the first half of the year, kind of riding all this out. And then everybody knows what happened in 10 and 11. Okay, fast forward to 2018, same thing. Everything's great. Fed's going to, hike rates all through 2019. These Wall Street guys are talking about 5% on the 10-year note. And the Fed was going to draw down the balance sheet, all this kind of stuff. And then what happened? The economy slows down, liquidity dries up, and they start cutting rates by June. Gold and silver take off. So I thought, well, that's probably the roadmap for what it's going to be like this year. And that's exactly what's happened so far. The risk to price, the pullbacks, have been due to periods where it seems like, okay, they're going to wait a little bit longer to pause and to start cutting. February, all of a sudden, the data seemed a little stronger, and so we got a pullback. Beginning in late April into the May, data got a little stronger, and we got another pullback. And rate hike odds kind of went up again, that sort of thing. But eventually, the Fed will start cutting, especially with an election year pending next year. And once that's universally recognized that the hiking cycle is over and the Fed is going to start cutting, that's when the metals eventually break out. Gold's gone up and banged up against 2,100 basically 3 times now. You just watch, Jesse. Once it gets above 2,100 by, I don't know, August, something like that, and starts steaming toward 2,300, which was my target this year, all those same folks that you mentioned earlier with the lousy sentiment and dumping their miners are going to come back in with their hair on fire for fear of missing out. And so I think that's how this will continue to play out. Nothing that's happened so far as in the first 5 months of the year has led me to think I'm on the wrong path.
And what's your take on silver here at the moment? A lot of people I'm talking to are pointing out that it's extremely undervalued compared to gold, that it possibly presents a more attractive value proposition, both the bullion and the miners. How do you see it?
There are a number of things there. I could probably go on for 10 minutes just talking about silver alone, but to keep it simple, I mean, the supply demand thing is, of course, interesting. The physical supply deficit, what the Silver Institute, 237 million ounce supply deficit last year. Base metals, industrial metals are all seeing dwindling global supplies, nickel and copper and the like. So there are a lot of really interesting fundamental things just on that basis of silver. Then you start factoring in, where it is relative to gold and the like. Here gold's trying to break out of its 3-year consolidation, and silver is, that breakout line's about 28, and we're down here at 24. You look closer at the chart, though, you can clearly see a pattern. Silver got down pretty close to the cost of production in the fall of last year, and that's about as low as it can go because the way the COMEX works, the banks start getting long and the specs start getting short, and that kind of puts a floor under price because the banks got to make sure they can get their silver. And that's what happened again last fall. So you go off of those lows. We've now made a high in January, a higher low in early March, new high in April, and what now appears, we'll see what the jobs report is on Friday, but what appears now is another higher low. That first rally off those lows took us into a little $1.50 box between 23.50 and 25. We pulled back. The next rally took us into a little $1.50 box between 25, which had been resistance, now support, and 26.50. I think the next rally, which, like I said, may have just started, probably targets 26.50, 28. 28 being that key level, because that's just like $2,050 or $2,100 is for gold. That's the top of the range for the last almost 3 years. You break out above there, again, you start getting short covering. You get this kind of initially panic buying, but everybody senses the momentum and starts rushing in. I wrote in January in that forecast, I thought we could get to 36. Maybe 32 or 3 is still a logical target for the end of the year, but silver can get so volatile that I don't know. We'll see. But I feel pretty good, though, that especially if gold's going to break out and go to 2,300, the silver break out above 28. Then once it does, it kind of takes on a little life of its own.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
What's your take on the debt ceiling debacle? I'd like to get your thoughts in as well. There's something you wrote on Twitter here, which is this is a level of financial irresponsibility that should be extraordinarily bullish for gold. But with everything now run by high frequency trading, price is likely to open lower. Could you elaborate on that and just give us your overall thoughts on how this whole debt ceiling debacle is proceeding?
Well, I wrote that back on, excuse me, on Monday of the Memorial Day holiday, where I was talking about the open Monday night, because when it's all just computers on a holiday night, when the Globex reopens at 6 o'clock Eastern, if the dollar index opens 20 cents higher, the machines are just going to dump gold $5 or $6 lower. It just is. And so on this fundamentally bullish news, of this infinitely expandable debt ceiling, you might see gold go down. That's what I was trying to state with that. But it is extraordinarily bullish. And there's two things about this debt ceiling deal, having to live through a number of these now. It's all theater. It's all garbage. It's timed before, as you go into an election year, to stir up the partisans. We got to get the R side of the uniparty all excited that maybe they got some concessions, and then the D side of the uniparty gets all excited that they won, and their partisans go out, yay, look at us, and it gets them all stirred up. But there's no way there was gonna it was just anyway. Here's the key takeaway, and I'm glad you brought this up. Back after the financial crisis, they did this trick before, where instead of a hard number, okay, you can only go up to $15 trillion. They said, no, we're going to extend the borrowing authority to a date instead. And why'd they do that? Because they'd raise the debt ceiling $500 billion. And then Congress would go through that like shit through a goose. And you'd be at $500 billion again like 6 months later. And that's just too obvious for people. But wait a second. Time out. Didn't you just do this? You already blew the 500 billion? And then people start to wake up. So about 10 years ago, they said, no, we're not going to do that anymore. We're just going to have this date certain thing. Okay, so then, I don't know what it was, 3 or 4 years ago, it was back when Trump was president. They went back to having a date again. Okay, I'm sorry, they went back to a hard number again. Okay, where he said you can only go, and that's what this was. You had this number that you couldn't go past. Well, these cynical politicians are back to having a date again. Because imagine if they had raised the debt ceiling by $1 trillion, just whatever, and that was a number again. After all of this media, spin and all this drama, if they came back, let's say March of next year, 5 or 6 months before the election, sorry, we already blew through that trill. We need another one. People go, wait, and they could be up again, right? So what do? The new debt ceiling is a borrowing authority through January 1st, 2025, conveniently 2 months after the next election. So there is no hard cap again. They're likely to spend and raise the debt by as much as $4 trillion in just the next year and a half. And again, where's that money going to come from? It's going to be printed by the Fed. Let me give you one more thing, Jesse. I printed this off, so I'm so glad you asked me this. I apologize. I got to put my glasses on. I got to read this to everybody. This is really, really, really important. I got this from Twitter. High tech, right? All right. Over the course of the next, I think it's 3 years, $24 trillion, 75% of the current debt is going to mature and have to be rolled over. The reason why debt service costs haven't soared with the debt over the last 10 years is because the Fed has kept rates at 0 and 1%. And the Treasury has moved all this borrowing into the short end of the curve to keep the interest costs down. Well, now the Fed's got 2-year notes at 4.5%, 10-year approaching 4, and everybody, they're going to go higher. Okay, sure. So $24 trillion is going to get refunded and reissued at, instead of 1%, 4. And now the interest on the national debt is going to triple or quadruple and all of a sudden be $1.5 trillion, $2 trillion a year. Hell, we're getting close to that's the entire revenue, tax revenue that comes in is going to be spent. So for people that sit there and say, oh, yes, rates are definitely going higher. Yes. Oh, no doubt about it. The Fed is going to hike because they're serious. The math is the math. Okay. Rates are going back down. And when you got to come up with all this extra cash, it's going to be go back down by yield curve control and the Fed enforcing yield curve control by buying everything above a certain level to make that level stay, just like Japan. That's where this is headed. That enshrines negative real interest rates. And that is always the massive driver, always has been the massive driver for gold prices. So again, we can sit here and go, oh yeah, geez, gold's down, sentiment's. This is extraordinarily bullish. Just the fundamentals extraordinarily bullish. And people have to take time and understand that.
So we're seeing a lot of brazen corruption in politics. And I just saw a documentary about insider trading by US politicians, and it's actually startling and insane. There's studies being done going back through the 90s showing that they basically, on a percentage basis, outperformed Warren Buffett, like a bunch over the course of the decade from like 90 to 99. These politicians beat Warren Buffett. And it's obvious that they're engaged in insider trading. Obama brought in some sort of act to try to restrict insider trading, but it's actually a complete joke. Not only does nobody follow it, the penalties for breaking it are so ridiculously low that it doesn't even matter. I believe like 74, 75 politicians have broken this, this supposed law that was supposed to be in place, and it's a slap on the wrist. They continue along their way. With the leadership this corrupt and engaged in insider trading, of course, we all know Nancy Pelosi is probably the poster child for this whole debacle. And these people are in charge of things like the debt ceiling, things like the economy. How does this all end? Is there any way, draining the swamp is maybe a term that's being overused as a cliche, but how do we get these people out of there? Is it term limits? Is it what do we do to restore some semblance of honesty to the political system?
Boy, that's the multi-trillion-dollar question, right, Jesse? And this is end of empire kind of stuff.
Yeah.
I mean, you read it. I'll give you this too. You've seen me do this before. I mean, this just stays right here on my desk. This was a very popular book 10 years ago, When Money Dies. And Adam Ferguson wrote that even longer than 10 years ago. And he compares the current situation to Weimar Germany. I mean, you get like 2 pages into the epilogue, or I guess that's what starts the book, right? Prologues at the end. Anyway, not an author. Wasn't an English major either. You get 2 pages into it. And he's describing Germany in 1921 to 1923. And you're like, oh my God. Like, you talk about history, not just rhyming, but repeating itself. And I think we know how that ended, with wild swings in political philosophy, war, depression, hyperinflation. I guess that's always been the thing that has concerned me most about how this ended. I mean, and that's, I guess, part of why everybody looks the other way with the politics and with the banks and the lawlessness and the corruption, is because nobody wants it to end because, oh my God, how bad it's going to be. But nature has a way of making it end. And so really all we can do is, prepare for when that happens. And I've always thought ownership of physical precious metals, what steered you through all these past cycles like this. And so that's why I've always advocated buying it. And that's why I own so much myself. Term limits is always, if I could wave a magic wand, but you're asking the people who would be impacted by term limits to actually approve it. It's probably not going to happen. It may take some type of conflagration, horrific event to get everybody recentered, both societally and politically. And I'm certainly not asking for that, but it may take something like that to get us back to, kind of a square one.
Yeah, very well said. And I'd like to end on CBDCs because we always discuss this when we chat, and specifically Unicoin, the Universal Monetary Unit. Now, there was some confusion. People thought that this was created by the IMF, but it was actually created by a group called the Digital Currency Monetary Authority. The founder actually appeared on the David Lynn report and gave a pretty candid interview over an hour long. Said, of course, all the fears about it are being overblown. Yes, they're going to try to give it to all the different governments of the world to use, and it's up to those governments to set the rules of the system. So he's claiming we're completely neutral. We just give this technology to all the governments, and then it's up to them. If China wants to be authoritarian and use it in an authoritarian way, they can. And so it seemed like he was kind of passing the blame off of anything that could possibly go wrong. He seemed like a pretty genuine guy, but he seemed to kind of not really understand the potential dangers. Have you looked into the Unicoin at all? And if so, what are your thoughts on both that and the push for CBDCs coming from multiple governments around the world right now?
Well, on the Unicoin, I haven't looked into that specifically. But I think CBDC, the central bank digital currency, is just an extension of what we've kind of loosely referred to as a war on cash for over a decade, right? What do you need $100 bills for? I mean, they're only used by, bookies and drug dealers and all these nefarious activities. So we're going to get rid of those. You can do everything by card. I mean, what do you look? You're not doing anything wrong. What do you have to worry about? That sort of thing. Whether it gets to the individual level where that's your only option, and and the things, the draconian stuff that we all worry about, that the government's going to dictate what kind of car I can buy. Oh no, you're not allowed to buy that. So you want to use your money, you got to buy. Whether it ever gets to that, I don't know. But I do think that what they're trying to do is circumvent the legislative control of the money supply. And what I mean by that is, if people remember the financial crisis, and the banks started to tumble, and they came up with this thing called TARP. Remember the Troubled Asset Relief Program or whatever, authorizing the Fed to buy whatever it was, $700 billion of crap at 5 cents on the dollar. And they actually, there was valued at 5 cents on the dollar or less, and to pay as much as 105 cents on the dollar for it to reinflate the bank balance sheets. Well, to be able to do that, they had to get a vote passed through Congress. Okay. To be able to continue to inflate the money supply, Congress has to authorize it first, all the COVID, programs and stuff. And then the Fed, here's the cash. But what they're trying to do with these CBDCs, in my opinion, is go around that. Think of like Silicon Valley Bank and First Republic and the rest. A bank gets upside down and is insolvent. Not a daisy chain where one tumbles into another, but just think of like a whack-a-mole. The Fed would like the ability to go whack. And, you need $10 billion? Whack. Here's a bunch of zeros and ones, and you're reflated. Without having to ask Congress, in some omnibus bank stress act of 2025. We just want to be able to hit this one, this one, this one. I got one more thing for you. I printed off. There was a FDC report on bank health. Came out, I think, yesterday or the day before. The latest FDIC update, the number of, they call it the problem bank list. There, at the end of the fourth quarter of last year, there were 4 on this list. Whether it was Silicon Valley Bank, I don't know. The end of the first quarter, there are 43. And the amount of assets in those problem banks went from 10.5 billion to 58. Okay. So as rates are now going back up, we're right back to where we were in February and March. 2-year notes even higher, 10-year notes not quite there yet. All these banks are, this is still a problem. It's not going away. We just had the second, third, and fourth largest bank failures of all time in 6 weeks. Oh, but don't worry, it's gone. So, right. Okay. What these CBDCs will be used for, at least initially, will be, okay, the first national bank of whatever is now underwater because of commercial real estate by $5 billion, and there's a bank run. They need cash now. Whack. That's what I think those are. And again, think of that as a gold investor, what that means fundamentally. Take out all the shenanigans, the COMEX, and the BS of the contracts and the specs that rush in and get washed out and all that. Just think about fundamentally holding gold versus dollars in a situation where the Fed can, and then all the other central banks can just willy-nilly, oh, here's 10 billion here and 20 billion here. And okay, I think I'd rather save in gold than in dollars or euros or yen or whatever it is for that matter. And again, kind of go all the way back to the beginning, Jesse, and we're depressed because our mining shares are down. Okay, well, whatever. That'll probably sort itself out over time. I am definitely not depressed about what's going on in the world when I look at the actual physical metal that I own. That is what allows me to sleep at night, and that's why I just keep buying it.
Well, that is a great note to end things on. But before I do let you go, for those who want to learn more, could you let us know about the TF Metals report? And if there's anywhere else you want to direct people online, feel free to do so.
Well, I appreciate that. The most important point, again, is to not get caught up in the day by day, and not get freaked out when you see some stock go up 50% like NVIDIA or whatever. I don't even know how much it went up and think, oh, I should be doing that instead. Sure, if you want to do that, knock yourself out. You got to recognize where this is all headed. And that's what we talk about at TF Metals Report. The tagline has been preparing for the end of the great Keynesian experiment since 2010. And we're still headed that direction. This debt is unsustainable. There will reach a point where maybe 100 trillion, I don't know, but we're going to reach that point where they can't print the dollars fast enough to service the accumulated debt. And that's when all heck breaks loose. And so that's all part of what we discuss. I provide content every day. The members of the site provide content every day. I think it is, well, the feedback I get is it's unlike any other site on the internet. We treat each other with respect. It's not people throwing bombs at each other. It's actual discussions, helpful information that not only I provide, but like I said, everybody on the site provides. It's only $15 a month. People say, God, you could charge 10 times that. But I'm not interested in that. I want as many people to join as possible so we can get the word out as much as possible, because these are perilous times. So I just invite everybody. I mean, if you're looking for kind of like a boat, with like-minded people to kind of shelter you through these events and where we're headed. So my site is it's tfmetalsreport.com. Just go there and check it out, please.
Great. I'll put a link in the description below for people who do want to check that out. Thank you once again, Craig. Always a great time chatting with you and looking forward to doing it again.
Thank you, Jesse. All the best.